Let's take a look at the Chapter 3 problems. And I just want to remind everybody, you can look at the key terms at the back of every chapter. Always just kind of make sure you have a good handle on these. That'll help you quite a bit with some of the assignments. You can just click on the term right there and you can see exactly what the definition is. And then I want to remind everybody that on the back of every chapter there's discussion questions, and I've given you the answers to those. So back in my.usf you have the answers for all of these questions right here. So where I'll start today is to take a look at the computational exercises right here. So here's what we'll start here with Goose Corporation. They're a C Corp, incurred a capital loss of $12,000 for 19, also had ordinary income of $10,000 for 19. Goose had net capital gains at $2,515 and $5,018, and they determined the amount, if any, the net capital loss of $12,000. That's deductible in 19. And then part B to that is determine the amount, if any, of the net capital loss of $12,000 that can be carried forward into 2020. So the key with this one is it says, so the answer is there really is no computational part for part A. Corporations can, the answer is 0. The corporations can deduct capital losses against capital gains, but not against ordinary income. Instead, net capital losses are carried back to the 3 preceding years and then carried forward for 5 years to be offset against net capital gains in such carryover years. So that loss can only be offset against gains in the current year and then going forward. For part B, it says determine the amount, if any, of the net cap loss of $12,000 is carried forward to 2020. So here's what they can do is they can carry some of that forward. And as you can see, they have the $5,000 loss right here. So they had they had a capital gain in 18 that they can carry that back. So remember, they can go back 3 years. They can go forward 5 years. So back 3, forward 5. And so they can go and cover for sure the $5,000 loss in 2018. And then the 2015 loss is too old. So that means there's 7,000 left over. So 7,000 of that loss is left over that could be carried forward to 20. Okay, so the answer is for A is 0 and for B is 7,000. And for question 23, Aqua Corporation purchases non-residential real property in May of 16 for $1 million. Straight line cost recovery is taken in the amount of $89,765 before the property is sold on November 27, 19 for $1.5 million. Part A, compute the amount of Aqua's recognized gain on the sale of inventory. For this one, they have the $1.5 million right here. And with that $1.5 million, they have to then back out 2 numbers. They have to back out the $1 million, and they have to back out the $89,765 for depreciation. So it's $1.5 million minus $1 million minus $89,765 is the answer, and that would be $589,765. $589,765. Then for part B, determine the amount of the recognized gain that's treated as Section 1231 and the amount treated as Section 1250 recapture of ordinary income. Okay, for part B, since we have 2 different types of gains here, we've got 1231 and 1250. Let me just kind of read you the rule here, then we'll do a little exercise in Excel that'll hopefully make it more, have more meaning. So the Section 1231 gain is 571,812, and I'll let you know how we get to that. And then the Section 1250 recapture is 17,953. So here's the key part is we are limited to a 20% number. So we're limited to 20% of the recapture. So up here in part, it says 89,765, and that is the straight line cost recovery. So I'm going to type in 89,765. We'll take that times 0.2. for 20% and multiply the two numbers, and we get 17,953. So 17,953 is the answer. So the section 1250 recapture is the 17,953. And then we take the gain from Part A, and the gain from Part A was 589,765. And then we take that number and we subtract out the 17,953. So you take that minus the 17,953, and that gets us to our answer of 57,812. Okay, and let me fix my formatting with those commas here. Okay, so that was Part A and Part B. So Part B had two parts to it. 17,953 is 1250 recapture, and then the section 1231 is 571,812. Okay, let's take a look at question 24. Excuse me. It says Nighthawk Corporation is a calendar year C Corp. They have $3,700,000 of adjusted taxable income, $125,000 of business interest income, 0 floor plan financing interest, and $1,004,000 of business interest expense. For Part A, assume that Nighthawk has average receipts of the prior year through period of $33 million. Determine the current year deduction for business interest. So remember that almost all interest is deductible for corporations, but there are some limits on it, and that's what they want us to figure out. But just a few limits to be concerned about. So for Part A, we have to take a look at a calculation to figure this out. So we'll go back to Excel. We'll just do that over here. And what we do is we take the 125 of business interest income. So kind of just going back to the question here. So right here, the 125. We take that number, and then from there we add 30% of adjusted taxable income. And we'll go back to the question. So adjusted taxable income is the $3,700,000. So take 3,700, and I'm take 30% of that. Okay, I'm gonna get $1,110,000. So the answer is the sum of those two numbers. So the sum of the 125 and the $1,110,000 is $1,235,000, and that is the amount of interest that I can use, interest expense that I can use for the year. So they did have $1,004,000 of interest expense. I can use $1,235,000. So almost all of it, but 1,235 is the limit that I can do. Then for Part B, the question here says assume they have average gross receipts of $23 million and determine what the current deduction is. And this is actually just kind of a little rule that we have to be worried about. So in the chapter itself, it mentions that under this scenario, they'd qualify for the small business exception. And that means the small business exception is that average gross receipts for the last 3 years are $26 million or less. And then there is no limitation on interest expense. So they can take the full deduction. So because it's under $26 million for the last 3 years average, they can take the entire amount. So $26 million is kind of the threshold. Okay, the next question is 25. And it says here, a closely held C Corp that is not a PSC, which is a personal services corporation, has $40,000 of net active income, $15,000 of portfolio income, and $45,000 lost from a passive activity. What is their taxable income for the year? So part of the answer, it's a closely held C Corp, meaning it's just owned by a few people. It doesn't publicly trade. And there's a rule about that. And so a closely held C Corp that's not a personal service corp can offset a passive activity loss against active net income, but not against portfolio income. So they can deduct $40,000 of the $45,000 passive activity loss. Because they got $40,000 of net active income, they can match that against $45,000 of the passive activity loss, but not all of it. So that they can only deduct as much of the active income as there is. So there's 40,000 active income, 45,000 loss. So the 40,000 of income can be offset. That just leaves for taxes only the 15,000 portfolio income. So basically the only thing taxed is the 15,000 portfolio income. Okay, question 26. It says here, compute the charitable contribution deduction, ignoring the percent limitation for each of the following C corporations. So for the first one, for letter A, Amber Corp donated inventory of clothing, a basis of 24, and a fair market value of 30 to a qualified charitable organization that operates homeless shelters. So the question here is, how much of this can I deduct? If I'm Amber Corporation, is it 24? Is it 30? Is it something different between those two? So part of the issue here is the contribution, it does qualify for the increased deduction amount for certain inventory gifts. So the amount above the basis. So we can actually get a deduction above basis because it's inventory that we are giving for the expected purpose of the taking care of the ill, the needy, or infants. Okay, and it's basically the needy is homeless shelters, right? And so we're giving them clothing that will go to help the needy. And because of this, what I'm allowed to do is take a 50% appreciation. So there's a rule here it's mentioned in the chapter. I can take the sum of the basis plus 50% of the appreciation, or I can take twice the basis, and of course I get whatever's lower. So twice the basis is 48, or I take 50% of the difference between the basis and the appreciated value. So 24 to 30 is 6,000. Half that's 3,000. So 3,000 plus 24 is 27. So I take the lower of 27,000 or 48,000. So for part A, the answer is 27,000. For part B, Brass Corporation donated stock as an investment to Western College, a qualified organization. Brass acquired the stock 3 years ago for 18, and the fair market value on the date of the contribution was 32. Western College plans on selling the stock. This is a contribution of capital gain property. It was bought at 18, now it's worth 32. And so because it's stock, and stock is intangible personal property, and the qualified organization's use of the stock is not relevant, but they do get fair market value. So if you donate stock, Western Brass Corporation donates this to Western, they donate it at its appreciated value because it's stock, it's an intangible property. Then part C, it says that Ruby Corp donates a sculpture held as an investment and worth $130 to a local museum, a qualified organization, meaning that they you can give them donations and get a tax deduction for that, which exhibits the sculpture. Ruby acquired the sculpture 4 years ago for $55. So it was worth $55, it's now worth $130. The question is, what is the deduction? And it is $130. It's a capital gain property. So its deduction is the amount of the fair market value. It's tangible personal property that's put to use related to the qualified organization's exempt function. So because it's a museum and because it is a capital gain property, we get the $130 deduction. Okay, question 27. Crane and Loon are two unrelated calendar year C Corps. They have the following transactions for the current year: gross income for each, expenses for each, and dividends received from domestic corporations, 15% ownership. So now the question is to compute what is the dividends received deduction for Crane and then Loon. So remember that when corporations own stock of other corporations and receive dividends, that they get a deduction for that. So for 27, we should kind of take a look here and notice that income was $180, expenses were $255. So just if you just kind of take gross income from operations and then throw in the expense from operations, they'd have a loss. Now they still have $100,000 worth of dividends that would give them a net income, but the operations is 180 and expenses is 255. So the answer would be 50,000. So they can deduct half of that, 50%. Here's the reason why it's 50%. The net operating loss rule applies. Since deducting 50,000, 50% of the 100,000, results in an NOL for Crane, which would be the 180 plus the 100 minus the 255 minus the 50, that would be a $25,000 loss. So because of that, they're capped at 50,000. And then for part B for Loon, the question is how much do they get? And the answer is 110,000. But notice that they get $300,000 of income from operations. Expenses are 310, so they had a loss of 10. And then we have to kind of look at the dividend down here. And it says we take 50% times 300,000 plus 230 minus 310 is 110,000. So the taxable income limitation applies. So the key with this one is if I take this, they're capped at 50% of, let me get this, I'm not going to say this right. So the answer is 50% times 300,000, which is 150. And then they take the 230 and then they subtract the 310 and they get down to 110 is the answer. And the last one we'll take a look at is 28. Cherry Corp, a calendar year C Corp, is formed and begins business on April 1 of 19. In connection with its formulation, Cherry incurs organizational expenses of $54,000. Determine Cherry Corporation's deduction for organizational expenditures for 2019. So the question here is when the company organizes, how much of those organizational expenses can they take? So the rule is that generally 5,000, the first 5,000 of organizational expenditures are expensed, and the remaining are amortized over an 18-month period. 180-month period. Beginning with the month of the corporation begins business. However, the 5,000 expense amount is reduced dollar for dollar for the amount of organizational expenditures in excess of 50,000. Okay, so keep in mind they spent 54, which is above 50. So let me just kind of show you the calculation. We'll get rid of this stuff. So the way this works is they can take that 5,000 is that first number that they can take, and then they reduce that by this amount here. So I'm going to take 54, which is the actual amount they had, minus 50. Okay, so what they have to do is take that 5,000 minus 54 minus 50, which is 1,000. So the answer is 1,000. So that's the initial part. So let me go back to the question here. So determine the amount, Cherry incurs organizational expense of 54, determine the amount of deduction for organizational expenditures in 19. So they start out with the 1,000 is the first number, and then what they do is they can take that initial amount that they incurred organizational expenses of 54,000. Then they subtract the 1,000. That leaves them with 53,000 left over. Okay, and then what they do is they can amortize that. And they amortize that over 180 months. So we can take this and just figure out how much that is per month. It's $294.44 per month. Well, per the question, this is April 1. So April through December is 9 months. So they can take that times 9 months. And then the answer is 2,650. So the answer is 2,650 plus the 1,000. So 3,650 is the answer.